If you're waiting for a pullback in gold, you could be waiting indefinitely. I would just buy it now, and if it pulls back, what's the big deal? I mean, it's going much higher. You can always buy more if it pulls back and you have extra cash. You can do that. You should be buying it because I think the downside is relatively limited. And even if there is a crash and everything, and the dollar goes up and gold goes down, I think stocks and real estate will go down much more than gold. So in terms of your purchasing power, in terms of your ability to use your gold to buy other assets, you're still going to gain value. But the risk you have by, just hunkering down in dollars, the dollar crashes. We have hyperinflation. And then you got a pile of worthless money. Then it doesn't matter how many you have. You can't buy any gold because nobody with gold will sell it to you for a worthless currency.
Despite the U.S. dollar strengthening to a 5-month high, gold climbs 1.22% to flirt with $2,400 an ounce, buoyed by geopolitical risks and inflation fears. David Schiff, renowned as an American stockbroker, is widely recognized for his insights into investment strategies. Schiff mentions a major shift in gold's trend in his analysis, highlighting a significant breakout from key resistance levels after years of sideways movement. Despite potential downturns, Schiff regards investing in gold as having limited downside risk, particularly when contrasted with assets such as stocks and real estate, which he predicts would face greater adversity in a market crash scenario. However, Schiff cautions against relying solely on dollars, as cited by influential voices like Elon Musk. From a technical point of view, Schiff believes that once investors recognize the unlikeliness of inflation returning to the Fed's 2% target and understand the historical trends pointing to higher inflation, they will drive higher gold prices. This sentiment aligns with studies suggesting that gold can effectively hedge against inflation over extended periods, albeit with notable fluctuations in its inflation-adjusted value over shorter timeframes. The current gold to CPI ratio of 6.4, compared to the historical average of 3.6 since 1972, underscores the potential for gold to outpace inflation in the present economic climate. Consequently, as inflation persists and investors seek to protect their purchasing power, the allure of gold and other precious metals as a store of value may grow. Research shows that between 1974 and 2008, there were 8 years when U.S. inflation was considered high. During those periods, gold prices rose by an average of 14.9% year over year. Gold has been an inconsistent inflation hedge, but there may still be benefits to holding a small amount of the yellow metal in your portfolio. Gold has historically had a low or even negative correlation to stocks and bonds, suggesting it offers value as a diversification tool. Now, we present the clips of Schiff's insights from his recent interview. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I think we've already broken out as far as gold hit a new all-time high, and we took out a lot of the resistance that was overhanging the market just above $2,000 an ounce. So we got above 2,400. So I think gold really has support just under 2,300 now. I think we've moved up to a level where we're now seeing support above what used to be resistance. But what might be the catalyst for a more substantial move that will get the price of gold to 3,000 and beyond would probably be the realization that inflation is not going back down to 2% and that the Fed is going to stop trying to get it there, or at least pretending that it's trying. I think the markets right now still are harboring this fantasy that a return to 2% inflation is possible. In fact, if you look at the break-evens on 30-year treasuries and tips, investors are expecting inflation to average 2.3% for the next 30 years. I mean, that is a complete pipe dream that that's going to happen. The low inflation that we've had since the '08 financial crisis, that's an aberration. That's the exception, not the rule. You look at the 40 years before the 2008 financial crisis, inflation averaged close to 5% a year. And the Fed never had a 2% inflation target when inflation was above 2%. The entire history of that target existed when inflation was below 2%. That's why they made it up. They used it as a justification to create more inflation because they claimed it wasn't high enough because we were still below 2%. But because they created so much inflation to get us back up to 2%, and the Fed doesn't have the political will to do what's necessary, because if they really wanted 2% inflation, they wouldn't have stopped hiking rates. They have a long way to go up. And Powell would not be telling Congress that he doesn't care about budget deficits and that he can't criticize them. He would be laying into the government for running these deficits, because there's no way we're going back to 2% inflation with $2, $3, $4 trillion a year budget deficits. It's just not even possible. So if Powell is not willing to stand up and do what's right and criticize Congress for doing what's wrong, there's no chance of 2% inflation. So when the markets get their arms around this, they're going to have to reprice gold much, much higher. There was a brief drop in gold when we had the crash in 2008. But you have to put that in perspective. Gold had moved from 300 to 1,000 from 2001 to 2008. So gold had a huge run. And then it pulled back 20, 25% with the financial crisis. Then, of course, it recovered and went to 1,900, made a new high. But we haven't had a big run in the price of gold. Gold's gone sideways for more than a decade. We've just broken out of major resistance, and it's not like we're miles above it. I mean, if gold was already 4,000 or 5,000 and you wanted to wait for a pullback, okay, I could see your logic. But we're at 2,300. Where's it going to pull back to? The breakout was 2,000, 2,100. I mean, we're very close to the floor. In fact, I was telling people on my podcast when gold was around 2,000 that was the floor. There are a lot of people who thought it was the ceiling. They were worried about buying $2,000 gold. And I kept saying, look, $2,000 gold is going to look cheap eventually. Don't worry about it. You're getting a good deal. And now it's slightly less cheap, but I think we've broken out. If you're waiting for a pullback in gold, you could be waiting indefinitely. I would just buy it now, and if it pulls back, what's the big deal? I mean, it's going much higher. You can always buy more if it pulls back and you have extra cash. You can do that. But you should be buying it, because I think the downside is relatively limited. And even if there is a crash in everything, right, and the dollar goes up and gold goes down, I think stocks and real estate will go down much more than gold. So in terms of your purchasing power, in terms of your ability to use your gold to buy other assets, you're still going to gain value. But the risk you have by just hunkering down in dollars is that the dollar crashes. We have hyperinflation, and then you got a pile of worthless money. Then it doesn't matter how many you have, you can't buy any gold.
During the interview, Peter Schiff voiced skepticism that the U.S. government would purposefully raise gold prices, as it would undermine the dollar's strength as the global reserve currency. With regard to the possibility of the U.S. Treasury joining other central banks in purchasing gold, Schiff believes it would convey conflicting economic messages. According to the underlying data analysis, the U.S. dollar has lost 98.27% of its purchasing power over this period, and other currencies showed similar results. Furthermore, Schiff believed that the world would inevitably return to a gold standard out of self-interest. He argues that the current monetary system, beneficial to the U.S., imposes burdens on other nations, forcing them to trade surpluses and finance American deficits indefinitely. Let's get back to the interview.
I mean, first of all, I think that's the last thing the U.S. government wants, is to help push the price of gold higher. Because a rising gold price is a bad sign for the dollar and its role as the world's reserve currency. I mean, the dollar's primary competitor is gold. Central banks have a choice. They can own gold or they can own dollars. And more central banks are choosing to sell dollars to buy gold. And so if the U.S. Treasury joined the gold buying party, that would put even more upward pressure on gold and create even greater incentives to buy it. And of course, that would send the wrong message, right? If the U.S. started buying gold, imagine the message that sounds. That's like, the policemen are having to, call in the police to protect themselves, right? I mean, it would send a message that things are not great, because we're telling everybody how great everything is. It's a great economy, the strongest U.S. economy. Inflation is going back down. So why would the U.S. be buying gold? It would be sending a mixed message to the world. Ignore what we're saying. Look at what we're doing, right? We could say one thing, but we're doing the opposite by buying gold. So that's not going to happen. We should be buying gold. We probably don't have nearly enough, but it's more likely that we might start selling our gold. I'm not even sure how much we've got left. But if the dollar, or when the dollar rather, really starts coming under attack, we'll blow through our foreign exchange reserves very quickly. We don't have that much as far as how many euros we have, or yen, or pounds. So we may end up having to sell gold. We'll see. But I think that's more likely than that we start buying. Well, I think the world is going to go back to a gold standard based on its own self-interest, whether it's led by the BRICS or not, because the current monetary system doesn't work. I mean, it works for some people like the United States because we are the beneficiaries of this deal. But the rest of the world has to pay the price, suffer the burden. They have to run huge trade surpluses and accumulate dollars. And then they have to loan us those dollars in perpetuity and never expect to get repaid because we can't. And so the world has to live beneath its means to enable Americans to live beyond their means. The rest of the world has to consume and save, and then make that available to the U.S. and finance these huge trade deficits that we have with everybody. And this is causing all sorts of problems, not only the drain on the resources of these economies, but by keeping interest rates artificially low to help sustain the dollar, they also end up with asset bubbles and misallocations of resources, and they screw up their own economy. So we're exporting our bad monetary policy all around the world. And I think the sooner the world rejects the dollar as a reserve currency and moves on to sound money, the better off they're going to be. Now, of course, that's when the pain really begins in the United States, and we have to start, behaving like a normal economy again. We have to start producing before we can consume. We have to start saving before we can borrow. And that transition is going to, mean a lot of losses, a lot of financial pain, maybe even civil unrest. It's going to be a difficult adjustment for America to make. But the sooner we make it, the better. I mean, the longer we succeed in delaying the day of reckoning, the more we have to reckon with. And so the more difficult it is. But it's going to happen. It is inevitable. So I'd rather deal with it now, as bad as it is, than deal with it later when it's even worse.
The main factors affecting gold's price are inflation, rising demand from central banks, de-dollarization of developing economies, microeconomic situation, and geopolitics. The combination of these factors will create conditions for the growth of gold price in 2024. In the first half of the year, the cost of the precious metal may exceed $2,200 per troy ounce. How might evolving global economic conditions impact the future trajectory of gold prices and its role in diversified investment portfolios? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.